Thank you so much for inviting us to discuss our paper at this conference. It's a great privilege to do so, and it's a shame not to be home in London, but to be doing it virtually, but such is the way of 2020. This is joint work with Ananta Divakaruni at the University of Bergen. I'm at the Federal Reserve Bank of Cleveland, and as such, of course, this paper doesn't necessarily reflect the views of the Cleveland Fed or the Federal Reserve System. Okay, so let me begin by summarizing the paper in one slide. What is this paper about? Well, many of you will know that one of the drawbacks of blockchain technology is a limited settlement problem. So, for example, Bitcoin can only handle about 7 transactions per second globally across the entire network. And this leads to congestion. If there's too much demand for transactions at any point in time, then transactions have to queue. Now, we observe that since the beginning of 2018, congestion has fallen dramatically. We show that the Lightning Network, which is a means of settling payments off-chain, has driven this improvement. We also look at SegWit, which is a technology that increases the effective size of blocks, but we find mixed results for that. And I should say that congestion has if you've been paying attention to 2020, congestion has gone up a lot recently, and I'll talk a little bit. We don't cover that in our paper because it's new, but I'll talk a bit about that at the end. So one question you might have is so what? Who cares if Bitcoin is handling payments better? Well, congestion is a big problem for Bitcoin. It has been. It's not hard to find examples of how congestion in Bitcoin has stopped it from working well as a means of payment. My favorite one is this example back in January 2018, when a Bitcoin conference selling tickets and accepting Bitcoin as a means of payment had to stop doing so because it wasn't working well enough. So while this evidence is this particular anecdote is indeed just one piece of evidence, one feels that if Bitcoin conference has to stop taking Bitcoin because it's not working well as a means of payment, then I think it's really not working well as a means of payment. And there are broader issues beyond Bitcoin. This is the congestion problem is something that affects any truly decentralized currency that runs on blockchain and is not controlled by a central bank or other central authority. So, for example, Libra, as it was originally proposed, was meant to be a global currency that was ultimately going to be decentralized and run on blockchain. But obviously, it would run into the same kind of congestion problem. A technology like the Lightning Network could allow it to scale up and truly be a global currency. Now, Libra isn't happening in that way anymore. It's going to be more like a group of stablecoins, but it's effectively being replaced in the public discourse by central bank digital currencies. So one of the most advanced central banks here is the People's Bank of China, which is going to release a cryptocurrency called the DCEP, the digital currency electronic payment. Now, this is likely not to run on blockchain, or at least not to be decentralized. And it's pretty likely that the Chinese authorities are going to retain a lot of control over the ledger. It's not going to involve a lot of miners. And it's going to allow the Chinese authorities to practice censorship. But in a world where we have competing central bank digital currencies, it might be competitively advantageous for some central banks to issue digital currencies that are censorship resistant, that aren't controlled by authorities. But it's very hard for an authority to commit to this. So what might, say, a democratic country do if it wants to commit to not controlling money? And we already have this. Central banks issue cash that is not controlled. It's not controlled by a central ledger. Any 2 people can transact in cash. So suppose there's some kind of internet version of cash. Now we have a central bank who controls the central bank digital currency, controls the ledger, and is able to look at what's going on. Now, if they could use a scalable form of blockchain technology so that it's not just the central bank who is the sole miner or who is the dominant miner, but there are, like Bitcoin, a large number of miners throughout the world, then the central bank can effectively credibly commit not to control and not to censor the ledger. And that could be, as I say, a competitive advantage. So technologies like the Lightning Network could really allow, it's not just about Bitcoin, it could really allow central bank digital currencies and private issuers to truly create a global currency. Okay, let me say a little bit more about about why Bitcoin and other cryptocurrencies have a limited settlement constraint. Now, in Bitcoin, blocks arrive on average about once every 10 minutes, and that's more or less hard programmed, at least in the long run. That is the long run rate of supply. And each block can hold about 1 megabyte of data, which is about 4,000 payments, give or take. Now, why does this limit exist? Why does it not allow sort of many more payments per second? The reason is that in order to achieve decentralized consensus, you need miners all around the world across the internet to communicate with each other. If I create a new block and update my local copy of the ledger, I need to send that new block to you. You need to validate it. You need to download it, add it to your local copy of the blockchain. And we all need to do that at roughly the same time so that we're in broadly in consensus. Okay, that's how a decentralized consensus has to work. So we are restricted by the speed of internet communication. And the bigger I make the blocks, the slower we communicate, and the fewer nodes can be active. Okay, so there is a trade-off here between security and centralization and payment efficiency. Now, in Bitcoin, as in most other cryptocurrencies, users, if I want to make a payment, I can attach a fee. This will incentivize miners to prioritize my payment. So if I submit a payment with a fee of 1 Bitcoin and you submit a fee with a payment of 0.8 Bitcoins, my payment is likely to be prioritized above yours. But this doesn't increase the overall, this doesn't move the supply curve out. It just determines how blockchain space is allocated between users. Okay, so this chart, in a way, it sums up the paper. It tells us what's been going on. I'll start with the red line, which shows the number of transactions that are confirmed each day in Bitcoin. You can see that in 2017, during that boom in sort of autumn, winter 2017, the number of payments reached an all-time high. But you can also see sort of mid-2019, there was a similar peak. Okay, it was nearly as high then. Now, the green line is a measure of congestion. It shows the number of payments that were waiting in the mempool, which is kind of a waiting room for Bitcoin payments. And you can see, despite the fact that demand was just as high in 2019 as in 2017, the amount of congestion was much lower, okay, considerably lower. As I say, we're seeing a similar amounts of congestion now, right now in 2020, so I'll come on to that at the end. Okay, this is another measure of congestion. It shows again that in mid to late 2017, the median settlement delay got as high as 14, 15 minutes. But by the time we got to 2019, it was back down to a long run average of 7 or 8 minutes. That's just the median, so it was quite skewed to the right. And another way of showing this phenomenon is by looking at fees that people attach to payments. So in this chart, the darker the color, the higher the percentage of fees, the high percentage of transactions that have low fees. So you can see in 2017, there were not too many transactions with low fees, that's the dark color, and a lot of transactions with high fees, especially around mid-2017. But by 2019, the number of high fee transactions, the proportion of high fee transactions was very small, and there were many more low fee transactions. So all of this evidence is consistent with the story of there being less congestion in 2019 than 2017, despite a similar amount of demand. Okay, so why has congestion eased? As I said, we know it's not due to lower demand because Bitcoin was handling more transactions. And we know it can't be due to fees pushing up incentives to mine to create new blocks, because that can only change the supply rate of blocks in the short run. But settlement capacity is fixed in the long run by the Bitcoin protocol. So we explore possible technological innovations that push out the supply curve, which is SegWit and the Lightning Network. Now in the paper, we do also explore Bitcoin Cash, which is an alternative cryptocurrency that's designed to handle more transactions. But in order to save time today, I'm not going to talk about Bitcoin Cash. We find zero evidence that users switch from Bitcoin to Bitcoin Cash, and that's helped ease congestion. that doesn't happen. So I'm just going to talk about SegWit and the Lightning Network today. Okay, and I'm going to very briefly explain what each one is. I'm sure there are many people on this call who understand SegWit and Lightning Network in way more detail than this, and indeed way more detail than I do. But hopefully what I describe here will be sufficient for understanding the paper. So SegWit is, you can think of it essentially as an increase in block capacity. It was introduced in August 2017 as a soft fork to the Bitcoin code. And that means it didn't create a new cryptocurrency. It just it's a new program that people can use if they wish, or they can keep using the old program and ignore SegWit. SegWit means that payments are being stored more efficiently. So very roughly, you can now store up to 4 times as many transactions on a block as you could before. Okay, so this means that there's an upward shift in the supply assessment space, but it is bounded. The theoretical limit for how much more efficient SegWit can be is a factor of 4. And not every transaction can use SegWit, and not every user is willing to use SegWit for whatever reason. Okay, so that 4 really is an upper bound. Now let me talk about the Lightning Network. And this is, again, to summarize it in one line, it's a means to settle, to net out a batch of payments, and then to settle it all on the blockchain as a single transaction. And the best way for me to describe this, I think, is with a single example. The simple example, so let's suppose the 2 users, Alice and Bob, the proverbial Alice and Bob. Now they have a deterministic stream of payments over 5 days. These are known with certainty. On days 1, 2, and 3, Alice wants to pay Bob 1 Bitcoin each day. And on days 4 and 5, Bob is going to pay Alice 1 Bitcoin each day. Now, if we just were to do all of these on the blockchain, each of these would require 1 on-chain transaction. So this would require 5 on-chain transactions. Let's say that the cost of that is 5F. Okay, because F is the fees that users have to pay, or is the cost of waiting. Now let's suppose we use the Lightning Network. The way this works is that on day 0, Alice and Bob will open a Lightning channel which is bilateral between the 2 of them. And Alice locks in 3 Bitcoins. So she puts 3 of her own Bitcoins into this channel. This is going to collateralize her net debit position. And then Alice can start making her payments to Bob through this channel. So on day 1, she pays the first Bitcoin. This is paid through the Lightning Network. It is not yet settled on the blockchain. By day 3, she's paid 3 Bitcoins. That's fine. Her position is collateralized. And on days 4 and 5, Bob pays Alice back a Bitcoin each day. So by the end, Alice has a net debit position of 1 Bitcoin against Bob. At this point, the payments have finished. So Alice and Bob agree to close the channel, and the coins are distributed. So Alice's 1 Bitcoin goes to Bob. This requires 2 blockchain transactions. 1 transaction on the blockchain to open the Lightning channel, which involves writing a smart contract and adding it to the Bitcoin blockchain, and 1 to close it. So in this example, the cost is simply 2F, which is a 60% saving from the 5F that we saw before. And there's really no limit to these savings. We could have had 1 million payments here. This would have cost 1 million F, and Lightning would still have cost 2F in this example. Okay, it's not always as simple as neat as this, but you can see that, at least in theory, Lightning can bring potentially unlimited savings in the number of blockchain transactions required. Okay, let me move on to our results. So we use daily data from the 1st of January 2017 to the 5th of September 2019. We're working to extend this and incorporate another couple of extensions, but I will talk a little bit at the end on what's happened in 2020. The congestion data comes from this handy website from Jochen Honecker. He includes data in particular on the number of payments waiting in the mempool and the fees associated with the payments. We have indicators on the usage of the Lightning Network and SegWit. Now, in each case, we have both a quantity indicator and a value indicator. So for the Lightning Network, we have the number of channels, the number of Lightning channels each day, and the total value of Bitcoin that's been locked in to those channels. And we measure value in dollars. For SegWit, we have the proportion of transactions that use SegWit, both weighted by volume and weighted by fee. We also use proxies for demand and supply, so we can be sure that changes in congestion aren't determined by simple demand and supply factors. And we use the REMA model, which essentially is a regression model that involves lagged terms. So we can control for historical events affecting current events, and we take first differences to get stationarity. Rather than show you summary statistics, I thought it might be easier just to show you a chart of what these indicators look like. So there's a lot going on here, but basically the blue line is the Bitcoin mempool. This shows you the number of transactions that are waiting. The green line shows you the number of active Lightning channels. So you can see it goes up considerably, especially in early 2019. It came off a bit during 2019. The gray line is the proportion of transactions that use SegWit. This is sort of went up a lot in the early days of SegWit and has since stabilized at around 30–35%. The red line is Bitcoin Cash. I'm not talking about that today, but you can read about it in the paper if you're interested. If I show you the same chart weighted by value, the picture is similar, probably even more dramatic. We see a big spike in the value locked into Lightning, and these spikes are likely due to sort of large individual users coming online. For SegWit, the adoption seems to be a lot more of a steady progress when we weight it by fee. So now around 40% of Bitcoin transactions weighted by fee are using SegWit. Okay, here are the regression results. Now I've got 3 sets of regression results. Each one has a different dependent variable. So here we're looking at trying to explain the mempool count. So how many transactions are waiting to be settled on the blockchain. The 3 models show how the Lightning network affects that, how SegWit affects that, and putting both of them together. Now in this case, we show clearly that an increase in Lightning channels means a lower mempool count. So when the number of Lightning channels increases, that reduces the mempool count. We don't find any significance with SegWit or with supply and demand factors. If we look at mempool, trying to explain mempool fees, so we're weighting everything by value here rather than by quantity, we again find an increase in the value of Bitcoin locked into the Lightning network reduces mempool fees. So when there's more Bitcoin locked into Lightning, the mempool fees are lower. Here, SegWit is not significant at the 5% level. Finally, these regressions show try to explain the proportion of transactions that have low fees attached to them. By low fee, I mean less than 10 satoshis per virtual byte. And again, here an increase in Lightning channels means that, so that's a typo, that should be more low fee transactions. So when we increase the Lightning network, there are more transactions that have low fees, which is again consistent with Lightning reducing congestion. Here, SegWit is highly significant, but it has a surprising sign. We would expect it to be positive. It's negative. So we need to do more work on SegWit. We think the problem is that the way that you measure a SegWit transaction in virtual bytes is different from the way that you measure a non-SegWit transaction, and that makes the SegWit transactions seem like they've got higher fees because the number of virtual bytes is smaller. So we're working on getting, so we've downloaded SegWit data directly from the blockchain, and we're working on figuring out the physical bytes for each SegWit transaction, which is a longer process, but that will appear in the next iteration of this paper. And hopefully we'll get more, we'll be able to understand these results better. So that's why this paper at the moment focuses on the Lightning network, hence the name. And we find a very clear result. The Lightning network effect is robust. Greater adoption of the Lightning network means lower congestion. And to put that, to give an idea of how much, we find that an increase of 1 standard deviation in adoption reduces the mempool count by about 1/3 of a standard deviation. Or to put it another way, if you took the Lightning network as it was at the end of our samples, that's about 40,000 channels, and you stuck it into the network in December 2017, when the congestion was at its peak, we think mempool count would have been about 95% lower, and fees would have been about 96% lower. Okay, so that seems like a huge difference, but it's in line with what we saw with the chart I showed you at the beginning. We see that an increase in Lightning network adoption really has a big impact on congestion. And with that in mind, let's talk about 2020 as I promised. So this is from blockchain.com. This shows the transaction count, the number of transactions in the mempool for the last year 7-day moving average. And towards the end of October, we saw this big peak in the size of the mempool. And actually yesterday, this is 7-day moving average, but if I showed you daily data, there was a massive peak in the size of the mempool just yesterday. Okay, so it was only yesterday, so I can't really fully explain it, but I'm pretty sure this is a demand story. So we've seen a huge increase. You may be aware, you may have heard something in the news about Bitcoin being on a tear recently. And so I think the congestion today is really just a story about increased demand. The Lightning Network has only increased in size by about 20% this year. SegWit has barely increased at all. So this is entirely what we've seen in 2020 is entirely consistent with our story. If you hold Lightning and SegWit at the same size and increase the demand, you're going to get more congestion. We would hypothesize that if we had increased the size of the Lightning Network this year, we would have seen less congestion. Okay, this is my concluding slide. So I'm going to conclude and talk about some implications. So our big conclusion is that an increase in Lightning adoption is associated with a reduction in congestion, whether you measure it by number of transactions or fees. These are robust results. And this suggests that Lightning can make Bitcoin a better means of payment and can make it scale. Now, there are lessons here, not just for Bitcoin, but other cryptocurrencies. Ethereum uses Raiden, which is their version of the Lightning Network. So this is something that all cryptocurrencies could potentially benefit from. And it's not just a payment story, it could also be a trading story. It seems that Lightning could make it easier to move Bitcoin between exchanges, or by reducing congestion elsewhere in the network, can just make it easier for arbitrage traders. This can reduce barriers to arbitrage, improve liquidity, and reduce differences in pricing between exchanges. It could also lead to an increase in bid-ask spreads, because market makers then face more informed money flowing between exchanges. We've got some preliminary results on this, and we do find a link between greater adoption of the Lightning Network and reduced price differences between exchanges. And as I said at the beginning, there are clear policy lessons for if you want to build a scalable decentralized currency that a country or the world is going to adopt, you might need some kind of technology like this to allow you to scale up. Okay, that's it from me. Thank you very much for listening, and I'm looking forward to any questions there might be.
Thank you very much for your presentation, Peter. If there are any questions, please do type them in the chat. I've got one for you to start off with. Given the subject is, of course, turning Bitcoin into money, do you really think, I mean, in your opinion, is the Lightning Network really going to turn this into a form of payment that is utilized, given now in the light of CBDC coming out, and also things like Ethereum with Ethereum 2.0 coming around, and various other L2 scaling mechanisms there to take transactions off chain? Where do you see Bitcoin fitting in with that?
Well, Bitcoin has, Bitcoin is still the biggest cryptocurrency. It still has a big incumbency advantage. And you see these perennial debates on Twitter, as there's as many now as there ever have been about, should Bitcoin be a store of value? Should it be a means of payment? People argue about this. I think it's pretty clear from Satoshi Nakamoto's white paper that just from the title, it's meant to be a means of payment. It's a means of money. Now, what we're suggesting is that it can have both worlds. People have switched to the store of value narrative because it's not working well as a means of payment. So if it doesn't work as a means of payment, store of value is all it has. But with Lightning Network, you can have the best of both worlds. We're not saying, so what we don't show is that it is being used as money at the moment. We're just showing it can be used as money.
Okay, great. We've got another question on the chat. Thank you. So do you have an opinion on the main hurdles towards the size of the Lightning Network responding to the increasing fees over the past months?
Thanks, Martin. I don't have a, so we, as I said, we're going to extend our data set to include 2020, and I think there will be a lot to take in. I don't have strong views on this. The Lightning Network, as I said, has grown by about 20%. It's not much. The value of Bitcoin in the Lightning Network has doubled, but I think that's more to do with the increase in the value of Bitcoin rather than anything else. So I think Lightning is not big enough to handle what's happened over the last few months. I don't know why that is. I don't know if there's reasons why people have chosen not to use Lightning, or if it hasn't, because most of the stories the last few months have been about trading rather than use as a means of payment. Maybe people aren't so interested in using Lightning for that. But yeah, this is, I don't have a good answer for you, I'm afraid, Martin. I think this is something we're going to have to think more about.
Great, we've got another one as well.
So, okay, I'm reading the Q&A. So this is about a democratic government would possibly allow it to be decentralized. How would that work? So yes, it would be an official currency. So I'm really likening, the idea here is really likening a digital currency to cash, by which I mean notes and coins. If I want to use, if I want to buy a coffee with a $5 bill, then you know, the Fed doesn't know what I'm doing, doesn't need to know what I'm doing, and has no way of tracking what I'm doing. It's just a transaction between the buyer and the seller. So part of the vision of a digital cash is to have a version of this, the same thing but on the internet, basically. So can we have a currency that I can use to buy things from you that works well as a form of money, where no single authority, whether it's a central bank or a commercial bank or PayPal, knows what we're doing. Now, and I'm thinking about a form of digital money that is as censorship resistant as cash. So it doesn't mean that you can do money laundering and tax evasion and criminal activities, that there would still be laws against that, but just as there is with the use of cash at the moment. But I'm thinking that if you have, you know, if China's launched a digital currency, if lots of different countries have launched digital currencies, you will get competition between them, between governments. And this could be one way for a government that isn't particularly interested in censoring the ledger to compete. And it can credibly commit to not intervening by using a truly decentralized blockchain system, by having miners, and by using the Lightning Network to scale.
Great, thanks. We've got one final one.
Okay, so the question is, do you think the CBDC, this is from Mehdi Husseini, do you think the CBDC will reduce the use of Bitcoin, as CBDC will be considered legal tender compared to Bitcoin as a store of value? I mean, yes, possibly. It depends. I mean, I think to link your question to our paper, I think we would argue if there is more adoption of off-chain scaling technologies, it would mean that Bitcoin is able to compete better with CBDCs. I think that's what our paper tells us about your question.